trades. This is a course that is, again, going to span a 2-day session. It's going to be fairly intense. I'm letting you guys know right now. I speak rather quickly. I'll turn the camera on and off throughout the course of the session. It's the first. It's actually one of the first classes I've ever done with the camera on. So welcome to the Virgin Islands. Hey, there's a disclaimer here in the Virgin Islands. Power can go off at any time. That's, it's one of the drawbacks of Virgin Islands. The other drawback is there's chickens running around everywhere. I don't really know what that's about, but hey, welcome to the U.S. Virgin Islands in St. Croix. This is actually home to a tremendous number of traders. There's actually a hedge fund manager, really world famous hedge fund manager, lives down the street. Another one on the other side of me. In fact, the office that we're in right now, which used to be a gym, this was a gym that we've converted back into an office. This very office had about $10 billion being managed out of it for a pretty considerable period of time. So we got that going for us. Anyway, as I was saying, we're gonna hop into the bulk of today's class. Again, the Ultima Income Generator class. So one of the first things we've got to pull up, it's a risk disclosure. We're not financial advisors nor a broker dealer. I think everybody is aware of that. My personal favorite, no soliciting, no recording, no photography, and don't feed the monkeys. All right, copyright disclaimer. This is ours. This is not yours. The other thing is, if you ever need to get a hold of me after today, no, do not stop into the Scottsdale office because I ain't ever going back. Have you been to the Virgin Islands? If you've not, okay, and you go back to like Arizona, it's ruined. Anyway, email support@theotrade.com if you need to get a hold of us after today's session. Again, support@theotrade.com. It goes to a common inbox. We're there. We're going to answer some questions for you. Again, I suggest that people kind of hold their questions until they get through the bulk of this, because most of it's actually going to be covered in some of the criteria here. This is me. Again, my name is Don Kaufman. Again, welcome everybody to TheoTrade. I'm the co-founder and lead instructor here at TheoTrade. I've had pretty much my entire adult life as a trader. In fact, I grew up around traders and was a derivatives risk manager literally right out of college. I've had about a 23-year trading career. I was also involved in the early startup days of Thinkorswim. I ran the education division, built the education division, and went on to actually run education over at TD Ameritrade for 5 years. I exited after a 5-year lockup clause at TD Ameritrade, and we of course built TheoTrade. All right, down to business. Let's get to it. Put your helmet on. Okay, put your helmet on. And again, there are going to be times where I'm going to turn this camera on and off throughout the course of today's session, because I'd rather you guys focus, intensely on what I'm about to present. If you're a first-time trader, again, welcome to TheoTrade. Put your helmet on as the following coursework for Ultima trades. It's going to be a little bit demanding. I like to tell people right up front that what we do here, okay, especially in today's session, all right, this is kind of the full Monty of trading, and I have never gone into this extent in any of the other classes that we've done in terms of the depth of logic that we're going to go into. So with that, you're going to get a little bit of the full Monty. I'm telling you right now, this is going to be overwhelming. Okay, it isn't instant coffee, instant tea. Okay, we're going to work you into this. We've got portfolios, and I tell everybody that right up front because this is the first time through. Yeah, we've built portfolios for you. Okay, our trade ideas. Nevertheless, you need to understand today, okay, the logic. When I say the logic, like there's going to be some theory, there's going to be some logic of premium selling. And then I also want you guys to be able to understand how to evaluate your risk prior to ever getting into anything. Like, no one is going to get into this business, full blown from day one. I want you to be able to actually understand, okay, all of the risk prior to ever executing a trade. And we're going to show you how to do this. And again, if this is your first rodeo, as I said, welcome. Grasp, again, big, broad strokes of logic. The criteria and the nuances will come later. Now, on the flip side, for those of you that are a little bit more experienced, you're going to be grabbing criteria and nuances. This is one of the courses I'm going to tell you right now. You're going to be able to watch this 4 or 5 times. I know that's going to be exciting for you, right? You're going to be able to watch this 4 or 5 times, and every single time you're going to be able to pull out little chunks, okay, more chunks, because the way that I actually put these classes together is actually on several different levels for, logic for the newbies, criteria for the hardcore traders. And then we're actually going to interlace some live trading in here. It's going to be a little bit of a free for all. Theo trade. One of the things that I fail to ever really discuss in any of these classes is people always ask me, like, what is Theo trade? You got a God complex? It has nothing to do with that. Okay. When we were building Theo trade, we're like, we need a name. Okay. It's a little bit about theory. It's a little bit about trade, and it's a lot about logic. That's what Theo trade means. It means theory, trade, logic. So to begin with, probabilities in this business, they're the law in the markets. And you're never, I just want you to know right now, okay, you ain't ever going to get away with anything in this business if you trade long enough. Never forget that. When I say you're never going to get away with anything, you're like, I did this and I got away with it. I sold naked puts. Okay. Thank you. They expired worthless. You trade long enough, that ain't never going to happen to you. You should just get that through your head right now. Okay. One trade, good or bad, can never define us, can't define us. Trading has got to go beyond one trade idea. It's got to go beyond, one individual trade. It's about thousands of occurrences and having the right logic over time. People get infatuated, with this idea. They're like, I'm just going to do this one trade, and it worked. Okay. And it worked, and it was on GameStop, and I made a bunch of money, and they're going to be chasing the unicorn for the rest of their life. And that ain't this business. It's just not this business. And I want you guys to know that right now. All right. This is about logic. This is about, really generating, all right, a viable source of income over time. And the logic, okay, has to be just impenetrable. And that's exactly what we're going to be discussing here momentarily. All right. So what are ultimate trades? To really kind of, simplify this for just a moment, before I actually get into some of it, but what are ultimate trades? Because, people look at this Ultima. So my expertise in this business has always been around volatility. Volatility, option modeling. People have heard of like the Black-Scholes and the Cox-Rubenstein and all of that. Listen, I didn't do a degree in finance. Okay. I actually did my undergraduate in molecular genetics with a minor in organic chemistry. It's exciting, huh? You want fries with that? And everything you did inside of biology and all the chemistry classes and all the physics classes I had to take, we used to use these like heat of reaction equations. And so heat of reaction equation is actually what the Black-Scholes model and options is based on. So it was actually a really easy and natural progression for me to go from this science degree into trading, because it was the exact same equations. So everything I've ever done always surrounds volatility. I'm a volatility guy, So there's volatility, there's Vega, okay, there's VAMA, and then there's actually Ultima. And people really don't know what Ultima is. It's the volatility of the volatility of the volatility. And if you're a Canadian engineer, you have to appreciate that. The bottom line is this: higher volatility has resulted in significantly more options premium. So obviously with the onset of COVID, and you guys could be watching this archive 5 years from now, and it'll still be viable. But with the onset of COVID, we saw substantially higher volatility. Okay. And that obviously makes option pricing a little bit more lofty, but that isn't the crux. That's not the reason for putting this class together. It's not. Okay. The reason that we are successful now with these ultimate trades and premium selling is options implied volatility skew has just taken off. The shape of the curve, like how options are priced, okay, have tweaked. It's skewed, and it's a skew unlike, you can describe, just regular skew, but then there's kurtosis, and the skew has changed dramatically, which I'll actually show you in a moment. But the volatility of the volatility remains at record highs. And just to boil that down, okay, option pricing ain't what it used to be the last couple of years, right? It's just, it's different. It's unique now. And that's important to know. It's important to know. So we talked a little bit about skewness. As I was saying just a moment ago, the curve, and this is the kind of stuff where I don't want to geek out. I don't need to geek out. Okay. But again, if you're a Canadian engineer, by the way, if you've never heard the Canadian engineer thing before, that goes back. So my days at Thinkorswim, my days at TD Ameritrade, I would always get these 6 or 7 page emails And whenever I got these emails, they were always Canadian engineers, and they were like, well, if the kurtosis is this, and I'm like, you're killing me, man, you're killing me. I get it, but you're killing me smalls. Anyway, if you take a look at this, all right, I'm done poking fun at the Canadian engineers, right? Now we'll have to move on to, brighter things now. So one of the examples I always give is like when you look at a regular distribution curve, this one, okay, this is a distribution curve. There's and I always say this, there's really, really good drivers and there's really, really bad drivers, but most of us fit into the meat of the curve, unless of course you're from where? California, in which case the curve is completely skewed because everybody in California is a horrific driver. Just living in California makes you a horrific driver. So what do? Okay, skew the thing down. Skew has changed dramatically. Okay, and that is actually what this Ultima happens to be. All right, so I promise it's enough. It's enough picking on the Canadians. All right, and then enough picking on some of those that are from California. Okay, we're good now. Anyway, I will show you some of the skews as we dive a little bit deeper into this. Is that all right with everybody? Good. Let's go. Part 1. Okay. This particular course is going to be broken into 7 definitive parts. Okay. You will need all 7 parts to be able to execute, all right, into one nice position. And I want you to understand that I'm going to get into the game plan. I'll turn off the camera and I'll go really deep in here. But when you look at these parts, okay, the parts are separate like tools, but you can't build anything unless you actually are capable of putting these parts together. I implore you, okay, do not execute trades. Don't think about executing trades. Don't think about even looking at trades until you have actually gone through, all right, the 7 sections of this course. It is going to be worthwhile. There are going to be nuances that are not necessarily covered in the slide deck. And I want you guys to have that understanding before you dive head on into this. What I'm doing here in part 1, okay, is just putting the 7 parts together loosely. I want you to understand the logic of where we're actually going with this in the most simplistic and the most straightforward terms. So with that, we are going to jump forward into this logic of, well, first of all, get your game face on because it's go time now. Traders are strategy centric. So this is actually a phrase that I've used in numerous courses here at TheoTrade. Strategy centric, like don't take that as a negative, okay? But when I got involved in this business originally, okay, we were not taught strategies. So market making firms and derivative, risk managers, they're not taught strategy. You're taught aggregation of risk. Everything we do as risk managers and everything we do, when I say risk managers, that person basically runs the portfolio. Everything you do, okay, to mitigate risk is exposure, exposure, exposure. Doesn't matter, okay, about putting the trade on. Everything was about how can we mitigate risk? How can we mitigate risk? So when you learn to trade as a retail trader, okay, you learn strategies. When I say strategies, what am I talking about? You learn an iron condor, you learn a calendar spread, you learn, an in-out spread, which is fine. I mean, you got to get into the business in some way, shape, or form. You learn to buy a call, you learn to buy a put. But when retail clients learn about options, they're guided towards specific strategies because it's cut, it's dry, it's clean, it's beautiful, okay? You become those strategy myopic, okay? Myopic, it sounds like a dirty word. Place a trade, manage a trade, go up in flames when that trade doesn't work. So you place a trade, you make money in the trade. You place a trade, you make money in the trade. You place a trade, you go up in flames. You're like, the humanity. Okay. Anyone can learn a strategy. Anyone can learn a strategy. But does the strategy alone drive success? Okay. Ultimate Trades is going to take you through, it's going to guide you through managing inventory, okay? And before I go any further here, you're going to hear a term consistently throughout the course, all right? And that term is inventory or inventory management or an inventory of options, okay? In the end, this business is inventory management. You want to build yourself into like the Amazon of option traders. What do? Hot potato, inventory, 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 inventory. You just roll through your inventory, inventory. No big trades, no big trades, just little inventory, little inventory. It's it's all over the place. The bigger you are, the more inventory you got. And it doesn't take a huge amount of time to manage it. So let's get started with Ultima Premium selling. Ultima Trades is a premium income generation system. It's inventory management. In moments, we're going to establish the overall logic and game plan. Just be aware of the following. All right. At first blush, so you got to get started somewhere, but at first blush, don't worry about the margin. Hold on. I want to say that again. Don't worry about the margin. Forget about margin. We're going to work the issue, people. Okay. We'll work that issue later. I got a lot of issues. Okay. We're going to work that issue later. But this means selling premium, okay, will be applicable to smaller accounts. So we have an entire section in the course for small accounts. And it's, everybody's like flipping through the slides already. Don't worry. I'll explain it all. And it's something you're going to be able to follow me into. But allow me again to teach the full Monty first. Let's not worry about margin when we're teaching. And then we're going to circle back to small account growth. So easy, Tiger, baby steps. Okay. The second part, we're going to place lots of little trades. It's going to freak you out. Okay. Management, like you're like, oh, okay. Oh, wow. Apparently I put Canadian engineers in here again. I'm sorry. Okay. I'm sorry. I got an email from one the other day. It set me off. Okay. Careful. He's easily set off. Anyway, we're going to place a lot of little trades. Management may seem intense. So just calm yourself down, Canadian engineers. We're going to cover inventory management. Lots of little trades. You're actually going to find easier to manage than one big trade. So the third part of this, okay, there are several moving parts. This is the second time I said this to accomplish the one goal. Make money. All right, let's present the entire process to the onslaught of queries. All right, so again, there's going to be an onslaught of queries in here, but let us get through the entire process, and then we'll actually take a lot of the questions over here. We're going to be here to help you, guide you through this process. We're going to walk you through the learning curve, all right, while trading. So, all right, as we said, kind of game on over here. Let's get into it. So game on, Ultima Premium. All right, what are we actually doing? Yeah, I quieted down the camera right now because I must focus. I must focus. What we want to do is just kind of explain in general, well, what are we doing? One of the first things that we're going to do, and we're going to learn here, is we're going to sell far out of the money premium. Okay, when I say sell far out of the money premium, yes, I'm showing you a nice, beautiful distribution curve, and here's your nice, beautiful distribution curve. And yes, this distribution curve is skewed. It's all skewed up. But if you have a $300 product, doesn't matter what the product is, okay? This side, everything on this side of the screen are going to be my calls. Everything on this side of the screen are going to be my puts. Everybody got it? Here's 300. Up here, for instance, is the 350 mark. Down here, for instance, is the 250 mark. Good? All right. So where we are, okay, this is where the stock, and this stock is called Stock is trading at 300. We don't own the stock. We have nothing to do with the stock. We never wanted anything to do with the stock. What we're going to do, okay, is we're going to go out and we're going to sell premium. How are we actually going to sell premium? Okay, we're going to follow very definitive criteria here in part number 2. So in part 1, we're just saying game on, Ultima Premium. All I'm doing right now in part 1 here is establishing what the bigger picture, okay, of this class is going to look like. And when I say in part 1, like here, you have this $300 stock, but this stock is actually an ETF, right? It's an ETF, it's an index product, doesn't make a difference to me. We're going to go out and we're going to sell, okay? We're going to sell a bunch of calls. And in fact, I'm going to blank the screen again, right? We're going to come out here and we're going to sell calls. And again, let's assume that we're going to sell them naked. For argument's sake, we're going to sell them naked. Then we're going to turn around. We're also going to sell puts. Are you afraid? Okay. Are you afraid? You should be. Because again, doing it completely naked is going to be quite scary. So here is this stock trading at 300, okay? And it's stock. Stock is the ultimate ETF, and it's trading right at 300. And you're going to sell, for instance, like 350s, you're going to sell the 360s, you're going to sell the 370s, you're going to sell the 380s, and this one is going to be in April, and this one's going to be in May, and this one's actually going to be in the APE quarterlies, and this one over here is actually going to be left over in March from earlier, and at the same time, you're going to be selling a bunch of puts. Okay, so in this particular case, here you are, and you're selling like the 230 puts. Okay, then you're selling what? The 215 puts. These are the 200 puts. And before you know it, you got some 195 puts on there. Okay, and you've actually sold all of this inventory, and you've sold it what? Naked. And you're like, wow, man, that's way out of the money kind of stuff. Cool. Okay, what's the problem here? And these are not rhetorical questions, all right? What's the problem here? You're going to sell a bunch of calls naked. You're going to sell a bunch of puts naked. And eventually, what's going to happen to you, all right? I mean, everybody knows this story. So anybody that's ever sold premium before, you go out there and sell a bunch of naked stuff. Sooner or later, the marketplace goes, come on, come on, come on. A little more, Don, little more, little further, okay? Just come on, come on. And then all of a sudden, bam, you know, the S&Ps crash and you're like, I'm on fire, help me. Ultimate Premium, okay, isn't just about selling a bunch of out of the money calls and about a bunch of out of the money puts. Listen, that part is utopia. Utopia is just selling stuff and never having to worry about it. You want reality? Sooner or later, if you sell premium and like don't hedge, okay, you're going to be in trouble. You're going to be in big trouble. I'm in big trouble. I'm in big trouble. Anyway, so we have to do something against this. Okay, what are we going to do against it? Well, that's the important part. All right, with all of this, you sell some calls, you sell some puts. Sooner or later, okay, let's get our hedge on. Hedge on! What does hedge on mean? We're actually going to use a combination of strategies out here. Okay, we're going to use things like RTS spreads. That's a risk twist spread. We're going to use VVS spread, which is a VIX volatility spread. Then we actually have a very infamous little inside hedge over here, and that's actually going to be called a gamma iron. By the way, the gamma iron has been phenomenal lately at hedging off my call risk because the market keeps rallying and I keep taking heat to the upside, but the gamma iron condor has actually been offsetting like anywhere from 1/3 to half of my risk. It's been good. You know, the cool thing about this business is this, okay? It seems so easy when you lay this out, right? The VIX volatility spread, the risk twist spread, the gamma iron. These are 3 different types of hedging mechanisms, okay? So the problem with most people is they go out and they sell a bunch of premium. And what happens when you sell premium, and just bear with me, okay? Here's exactly what happens when you sell premium. That's why I wanted to spend a minute, okay, going through some of this criteria here. You sell premium and you go, you collect $1, okay? You collect $1, you collect $1, you collect $1, you collect $1, you collect $1. So $1, $2, $3, $4, $5, $6 you've collected. You start to scale up, you collect $1, there's 7, there's 8, there's 9. But the trades you're doing have 90%, okay? 90% probability. So what's going to happen eventually though, is you're going to take one big hit. You're going to take one big hit and you're like, oh, boom, you lost $9. And the problem is people scale up when they do this because they haven't had a losing trade. So they actually end up losing more than 9. Okay. So you made $9 and you give it all back in one trade. All right, come on. How many people have ever done that one before? Huh? Anybody? Anybody? Has anybody ever done this before? Has anybody had the plight of the premium seller? Okay. Anybody been through the plight of the premium seller? Make money, make money, make money. Do more contracts, do more contracts, do more contracts. Ah, gotcha. Okay. And you're like, what the hell just happened to me? And they go, well, that's the market. Because as I said, probabilities are law in the markets. I started with that, didn't I? All right. So it's like I thought ahead. All right. To get positive expected returns. Okay. That's what we're here for. When I say positive expected returns, like I don't want any miracles. I just want positive expected returns. I want to make money over the long run. Okay. The key here is this. It's not about the making dollar, making dollar, making dollar. That's pretty, self-explanatory. You can't lose 9 because if you lose 9, you're dead. It's just not worth it. Okay. So you cannot lose 9. To not lose 9, you just have to mitigate risk. And you have to be good at mitigating the risk. You have to understand the risk to be able to mitigate the risk. So instead of losing 9, let me just throw this out to you. Instead of losing 9, okay, maybe only lose 5, maybe only lose 4. I'm going to tell you right now, the better you get in here, okay, at premium selling, okay, the better you're going to be able to mitigate the risk, because it's not even about like tactically speaking. And I want to share this with you because here, listen, it's not even about like tactically speaking, like anybody can go out and they can sell premium, and anybody can go out and they put on these risk twist spreads and these VIX volatility spreads. It's about your understanding of both of them combined. And that's what we're actually going to do, not only the course of today and tomorrow, but as you actually watch me in portfolio management. And I'm going to be very frank, it has taken me years to understand like how, and it took me a lot of my career to understand how people not only go wrong, okay, but how the marketplace breeds like complacency in you. Because what occurs in a lot of cases here, all right, it isn't your lack of ability, okay, why people lose money when they sell premium. It is in large part the marketplace training you to be that complacent trader. The marketplace training you, all right, to say, you know what, I haven't had a losing trade in like 18 months. Why do I need these hedges? Trust me, you need the hedges. So to lay the game plan out, sell far out of the money options premium. That seems easy enough. We're going to do that here in a minute. We're going to sell far out of the money options premium. We're going to use risk twist, VIX volatility spreads, gamma irons as hedges. That seems pretty easy. If you haven't watched those classes, we have classes on there. It's one of the great things. Like when we built TheoTrade and we were talking about like, hey, you know, how are we going to put this TheoTrade thing together? One of the first things I said is, I want to make sure everybody has access to everything we've ever done so that we can build on classes. So we can actually sell far out of the money options premium and then say, hey, go watch this class for the best hedge. Go watch this class for the best hedge. Big portion of this, distribution of capital. Distribution of capital is critical to multiple expiration cycles over many strike prices. Distribute capital, managing aggregate risk, and then closing profitable trades and continue to allocate. Rinse, repeat, rinse, repeat, rinse, repeat, rinse, repeat. That's the game plan, right? Couldn't be more straightforward. Sell stuff, okay? Hedge stuff, splatter stuff, manage stuff, close stuff. Easy enough. All right. As I said, sounds easy enough. It's like I wrote this or something. Sounds easy enough, but manage the risk. Ultima premium selling is going to use, okay, high probability 90% plus trades, whereby most of the time you don't even need to manage it. Like seriously, most of the time you're going to be like, oh, woof, this is easy, man. I got this. Okay. Nevertheless, this course is all about, okay, covering your proverbial beep when the beep hits the fan. That's the one thing people have to understand. Okay. Yes, we put in the emoji. Okay. The poop emoji. So you got to understand that selling premium is the easy portion of it. It's covering your bottom when well the crap hits the fan in the marketplace. Anyone watching this class that sold premium in the past, you know the fate of the premium seller that cannot collectively manage their risk. Ultimate premium, it's going to change all that. We sell, we hedge, we gain edge. We sell, we hedge, we gain edge. All right, this is where we're going to cut the cord a little bit over here right now. And we're going to start to get into premium selling criteria, okay? So if this is the first exposure you've had to criteria, okay? Congratulations, welcome to criteria. So if this is the first exposure, I just realized I'm on camera, but hey, okay, it's my rainbow bottle. Oh, the coffee's flowing now. So in part 2 here, we're just going to walk you through selling the out of the money premium. No hedges, no hedges. All we're going to do right now is talk about splatting risk way out of the money, okay? I'm going to give you a lot of criteria here. If you've been through criteria before here at TheoTrade, this is like old hat to you, like you get it, right? Pick up little nuances. There's nuances in here, and people forget about stuff and criteria. Also, at the end of this section, there's a Cliff Note version of this. Don't look at it yet. Don't ruin the surprise. It's actually really easy to sell criteria, or the selling premium criteria. It's really easy. I mean, like, this is some of the easiest criteria I've ever put together. But here's the key to the criteria. You have to be incredibly consistent, deadly consistent, okay, with what you see. You can't deviate from some of the stuff I'm about to talk about. And if you do, okay, you're already dead. You just don't know it yet. All right, let's get into some of that criteria. Step one, okay, so we're going to go through, I believe this is it's a 7-step program. Well, this is not a 12-step program. This is your 7-step program. Okay, we have to select a product to sell premium. Remember, there's going to be a Cliff Note version of this, okay? Cliff Note version later. So you're like, yeah, the Cliff Note version, I'm that guy. Step one, selecting a product to sell premium. I'm going to make this easy. Most of you listening to this are probably going to be using, okay, a derivative of the spiders. Something like, okay, the ES options on futures, the futures micros. We will talk about that tomorrow, okay? But for those of you that have a little bit more capital, and again, I'm not making capital a consideration for today's course, right? That's something that's going to come up extensively tomorrow. I want you to select an index ETF or S&P 100 equity product only, okay? S&P 100, okay, equity product only. So why? Okay, obviously this is very recent, so I'm going to discuss it. But everybody remember just a few weeks ago, and again, you know, we're doing this in 2021. And people of the future, if you're listening to this, there was a company called GameStop. There was a company called AMC. They were not S&P 100 companies, and they actually blew up an entire hedge fund. You go, how is that possible? Well, one of the simple pieces of criteria, by the way, this is in other classes as well. Like, this ain't new for me. I didn't just add this recently because it happened, okay? But one of the things that's been in our criteria for a long time, if you're going to sell out of the money calls and you're going to sell them naked, you have to sell an S&P 100 or ETF. Why? Because the probability of an S&P 100 stock being acquired, takeover risk, it's greatly diminished. They're the 100 largest companies by market cap. It happens from time to time, but even if it happens, if it's S&P 100 and it happens, the move up probably wouldn't be more than about 20 or 30% max. So we limit stock selection to large caps to minimize the risk of your short candidate being acquired or caught in a gamma squeeze. So if you're selling out of the money calls, which you're going to do, it's really going to mitigate the risk. There's very few S&P 100 companies that are also being caught in gamma squeezes. They're too big, too difficult to do. So that's step one, is just use an ETF, use an index. By the way, we're going to go very, very deep into this. So, you know, calm down there, cowboy. All right, calm down there, cowboy, because because the next thing we're going to talk about over here is S&P 100 is great, ETF is great, but that's not going far enough. Like, this is not going far enough. So step two says liquidity is mission critical. Now, this is something that, again, I'm going to tell you 100 times over. Every single class we do here at TheoTrade talks about liquidity. I cannot stand when people get caught in an illiquid product, because when you're not liquid, that is when you can get caught in a gamma squeeze. Now, a gamma squeeze, all right, gamma squeeze is when, like, things can get ugly in a hurry. There's a huge short position in a small stock, okay? The bid offer spreads aren't that wide. People start accumulating all kinds of options positions. And listen, heavy liquidity, there's no way that that's going to occur, all right? It's just not going to happen in an S&P 100. It's not going to happen in some of these monstrosity products over there. Maybe small, okay, but nothing on the likes of an AMC or a GameStop. So liquidity, it really is, and I need you to know this, mission critical, okay? Liquidity. Underlying must have massive liquidity. Liquidity is essential. Tight bid offer spreads, high open interest, options availability. Now, before you start freaking out and asking me like 20 questions about liquidity, don't worry, there's more slides on this. Liquidity is variable, but generally you want to be the smallest fish. You want to be the smallest flounder in the largest pool, okay, in order to achieve viable trade execution. We're selling 90%. This is, if there's a key statement on this slide, it's this one. We're selling way out of the money option premium. And you may need to close trades eventually in the heat of battle. You're like, what is the heat of battle? Okay, the heat of the battle could be, you know, a marketplace that is just on fire. You're like, I'm shrinking. The marketplace as a whole starts to see just huge amounts of volatility. And if you're not in a liquid product, you're in trouble. You can only close stuff in the heat of battle, right? In liquid products. So just be aware of that, right? And I'm not done. Liquidity means trade liquid stuff. Was that self-explanatory? No, because I actually put like, you know, 5 different ways of saying liquid in here. Check the option volume in front month contracts. Open near-term monthly options expiration. Okay, examine volume, just several at the money. Forget about out of the money strikes. At the money strikes have volume in the hundreds. Okay, at the money refers to strikes near the underlying price. Option volume is critical. Option volume is just critical. And again, start here. So I get even more specific. We start with ETFs, but we can expand our horizons to S&P 100 products later. Stick with underlyings offering weekly options. Liquidity is your friend. Trade massively liquid market stocks, ETFs, okay, where you just don't have to question liquidity. You know, if you, and I'm not trying to be facetious in any way, shape, or form, because products really do, they fall in and out of favor. So you kind of have to reevaluate over time. And I'll give you a perfect example. Lately, I've traded a couple of products in here, but lately I've been, you know, over the years, I've actually traded like XHB. And then I started opening up XHB and I looked at volume and open interest. And I'm like, this doesn't look good. It's kind of falling, you know, off my radar list. It's not good. I mean, listen, I get it. There's some 4,000 here. There's some, you know, some of this there and yada, 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 a couple here, a couple there, but this one isn't doing it for Don. And this is an ETF. What is doing it for Don? Like, look at the spiders. Okay. Look at them. Look at the spiders. Is there any question? You open up like the monthlies in here and I have every single strike open. I just don't think, you know, you don't have to look too far to find some stuff. Look at this marketplace. It's incredible. You know, you can go 80 something days out, and the markets in here, they're incredible. You know, 5-cent wide markets and 8-cent wide markets at most on like $13 and $14 options. Like, liquidity isn't that difficult to find. So, you know, SPY, QQQ, IWM, large products have more risk. SPX, NDX, RUT, only even look at those if you're a highly experienced trader. Only look at those. All right. So I just stressed to you again, candidates could include the following. All right, SPY, TLT, QQQ, XLE, IWM, GLD. Huh? I threw a little GLD in there. EEM, the emerging markets. SPX. What did I just say about the SPX? What did I say? Okay, I said the SPX. It'll be the death of you if you get on the wrong side of it. All right. You're also going to learn about margin constraints. Have no fear. Options on futures are here. Okay, these products are going to be talked about extensively because they're phenomenal. They're phenomenal marketplaces. And if you've had no experience with options on futures, okay, we're going to give you some experience with options on futures because it's a better margin situation. It's a better use of your capital, even for the more experienced traders. Okay, if you looked at like SPX, you'd rather actually trade the ES options on futures because it alleviates margin all right, in just a huge, huge way. So I wanted to elaborate upon that for just a moment. So again, in step one, we just say, hey, what? Trade equities and ETFs, trade equities though, equities that have, right, what? S&P 100. And then we turn around in step two. In step two, we say just trade liquid stuff. And this is all liquid stuff. It only falls in and out of favor. And then step three, we just say it couldn't be easier than this. And again, I want you to know. And again, there's going to be some new traders in here. There's going to be some old traders. There's new traders and there's old traders, but there's no old bold traders. Something along those lines. Anyway, I want you guys to know right now, the step three couldn't be more straightforward. I needed a nice, simple, gentle way to say this. Make sure your implied volatility, this is 30-day implied volatility, is under 90%. If you're going to trade equity products, do not trade any equity product with a 30-day volatility. 30-day implied volatility is above 90. Okay, that's the you're putting yourself into a skew that I cannot anticipate what could happen if you're over a 90% implied volatility. That's just the bottom line. Like if you're over a 90% implied volatility, the skew in the marketplace can be just wild. So we want some volatility, but we don't want to be caught in the crossfire of insanity. The other aspect, I think that's viable in here, there's not a minimum bar for volatility because we are using hedges to mitigate risk. However, experienced traders, if you're an experienced trader, you can start looking at volatility rankings. And I want to leave it pretty much at that. Like, again, if you have an extreme amount of experience, you can look at like 500-600% volatility products, okay? But I can't hedge you in those cases. So I'm telling you right now, if you get over 90% implied volatility in an equity product, okay, you won't survive because the hedge is not going to work the way you think it is. And it's a problem. It's a problem that I can't overcome. I know how the trading firms overcome their problems when they have over 90% implied volatility, but as a retail client, we can't overcome that. So the answer is just use under 30-day, okay, 30-day implied volatility under 90%. Again, experienced traders can look at an IV ranking. Where do I find the 30-day volatility? Okay, well, 30-day volatility is under 90%. This is actually looking at Tesla. Hey, look at this. I took the screenshot just the other day. It was $781. Swing and a miss. It's no longer $780. Tried for the corner and missed. That's on Thinkorswim, but if you're on Tastyworks, and I think it's appropriate to pull this up because I'm trading more and more every single day on Tastyworks. Look on Tastyworks. What do you think the 30-day implied volatility is? 30-day implied volatility, it's right there. Just as close to 30 days as you can get. Look over there, look, it's like 44%, okay? And that's fine. I mean, that's literally, all right, we haven't hit a hard step yet. Step one, get an ETF, get an equity in the S&P 100. Step two, make sure the product is liquid. Step three, under what? Under 90%, okay? Implied volatility on the 30-day. Are we there yet? Are we there yet? Okay. Step four, options expiration selection. Okay, this is going to get a little bit deep. All right, so the honeymoon is over. Honeymoon is over right now. So when I say it's going to get a little deeper from here on out, yeah, it's going to get a little deeper now. So let's get ready to rumble. Okay, what we need to do in this case is expiration selection. When we say expiration selection, so we've gone out and we picked a product. Pick a product, any product will do. No, let's say that we use SPY, okay, or in this case, QQQ, or maybe even IWM. Any one of those three products. We have to look to sell premium 42 to 115 days out. People, that's actually a really, really wide berth. Okay, 42 to 115 days out, like what the, okay, that's a big field. That is a big playing field. Okay. Longer duration, far out of the money options actually have high burn rates. Okay. If the correct delta is selected, which we'll come to momentarily. The expiration selection window of opportunity is wide open in order to allow for sufficient spread of capital across varied expiration, strike prices, and volatilities. Okay. We are not initiating trades selling short dated premium. Okay. We are not initiating trades selling shorter duration premium. Okay. So once again, let's talk about this a little bit. Let's be rational about it. Okay. Your window is 42 to 115 days. 42 to 115 days. So let's go right to a trading application. All right. I'll start here on Thinkorswim. I will then move over to Tastyworks. So what is your window of opportunity to sell premium? Let's circle. Okay. Everywhere from here, okay, here, all the way out to here. Look at that. So you have 1, 2, 3, 4 expirations. Four expirations to select from. So sorry, I started getting into the count. That would be in the spiders. Four expirations. Anyway, come into the QQQ. If you go into the QQQ, you have the 52-day, you have the 87-day, you have the 115-day. You only have 3 expiration cycles. Great. Going to the IWM, probably fairly similar. Okay, 52, 87, 115. Look, you're like, but Don, okay, you naughty Don, you have 31-day options on. Yeah, I do have 31-day options on, but I didn't put them on yesterday. I put them on when they were like out here, and I've been burning them, right? So I wanted you to see that because you're like, he violated his own rule. Okay, no, I didn't. Okay, I've had it on for a while. So I've had stuff on for a while, and I pull up that trading application, and then we pull up Tastyworks. Same deal in Tastyworks, right? So look, 52 days out, 87 days out, 115 days out, doesn't matter what product it is. It's pretty easy, okay? And again, it's important that you know why this stuff, okay? Why am I doing this? Theta, going in and just accepting criteria, like a lot of people, like they just 42 to 115 days, check, got it, okay? But you need to know why. You got to know why. Theta burn rates on far out of the money options, okay? Option premium sellers often use short dated options. Like premium sellers, when people learn to sell premium, they often go out there and they go, oh yeah, man, I'm going to use me some short dated options, yada, yada. Okay. And that's all well and good. But I'm going to tell you right now, shorter dated options carry huge amounts of gamma risk. However, therein lies why you're tuning into this course on Ultima trades and why specific criteria is of such critical importance. Theta is the daily whittling down of an options premium. Options far out in time actually have high theta burns, okay, with low delta options. Let me show you. Let me explain you something, okay? So it's worth, listen, okay, say what you will, but as I said, understanding this stuff, forget about the criteria for a second. If you're new to this, like I want you to understand the why, okay? When a lot of people go out and they learn to sell premium, they go, oh yeah, man, let's go sell something with 20 days left. I go, why are you selling something with 20 days? Because people kind of do things blindly. Well, I heard through the grapevine, and everybody hears this through the grapevine, okay? The closer you come to expiration, the larger the burn. So these are $6.28 options, and then they'll burn slowly to $6, and all of a sudden, boom, they hit $4, and then oh yeah, now they're only worth $2, and then they're worth $0. But the only thing you have to remember is this: the amount of risk that you have to take to get that acceleration. The risk is what? Okay, and if you look at risk actually outweighs decay. All right. And that risk is actually what we term negative gamma risk. And negative gamma risk. And you go, I don't even know what negative gamma risk is. And I say, good. You don't want to know what negative gamma risk is because negative gamma risk is a big, ugly beast. Okay. And it has teeth, people. It has big teeth. Well, let me show you something interesting. Okay. Here is a $6 option. And it burns at 16 cents a day. You with me? So this $6 option loses, 15 cents a day. 15 cents a day. And you go, okay. And that only has 20 days to go to expiration. Now, okay, let's go way out of the money. Let's get crazy. All right, let's go 87 days out. I can go even further, but let's just do 87 days out. Okay. And we're actually going to pull up something called delta, delta, delta. Okay, delta, delta. Here, delta. Let's go to the delta of 10. Here, okay, this is not, okay, a 20-day option. This is an 87-day option. And you're like, it only burns at 3 cents a day. Yes, but it's 3 cents of a day of what? $1.35 option. So on a percentage basis, 3 cents a day and $1.35 option versus 15 cents a day, okay, of a $6 option. If you actually start working out the percentages, okay, you tell me. Think about this for a second. You had to sell the at the money option to get 15 cents of burn on a $6 option. On a percentage basis, you're like, oh, okay, it's 15 cents and $6. Here you're getting 3 cents of burn, 3 cents of burn on a $1.35 option with 87 days left. Okay, you're not even going to hold it for 87 days. This burn rate is phenomenal on a percentage basis. That's the one thing like people don't get. Now I'm gonna step in here and I'm gonna get even more in depth. The option that I'm highlighting right here is a 427 call. All right. And I'm actually going to write it up here because this is one of the most crucial areas of the class that is often missed. In this case, we have a May, okay, 427 call, and it's trading for, let's just put it at the ask, $1.36. Okay. What's that option going to be worth approximately 30 days from now? The only way to figure that out, look at the 87-day option, then look at the 52-day option. Why look at the 52-day option? Because a 52-day option is the same as an 87-day option. You go, no, it's not. There's like a lot of difference in time, Don. There's like 30-something days. I'm like, no, but it's the same thing. Because if you looked at a 427 call with 87 days to go, why don't you look at a 427 call? Look at the 427 call with what? With 52 days to go. Okay. And the option now is only trading for what? Okay. Now we have the APE 427 call, and it's trading for 34 cents. Let's just say after commissions and everything, you make $1. You sold the thing for basically what? $1.36. You could buy it back for 34 cents. You make a buck. You make a buck. So you're making, all right, and again, I just want to round it. You're making over 60%, assuming the market stayed totally and completely flat, but you're making over 60% for doing absolutely nothing. Okay. Absolutely nothing, selling a way out of the money option and doing nothing. Okay. Because the burn rate is decent. Are we okay? All right. Are we okay at that point? Because it's one of the most critical aspects that's often missed is that options have absolutely unequivocally have decent amounts of theta even further out of the money, right? So I hope that that makes a degree of sense. I mean, come on, we can even go, as I said, one of the pieces of criteria, you can go 115 days out and you go all the way out to this 9 delta. And this is the 435s. Look at this, and this is trading for like $1.50. These are trading for like $1.50. Okay, $1.55, and then you open up with 87 days out. Okay, and that was the 435s, 435, 435, 435. Boom! Now they're only trading for what? 80 cents. Okay, you're losing almost half the premium. Almost half the premium in what? Okay, that isn't even like, but it's not even a full month. Okay, it's not even a full month, and the amount of risk 115 days out, you're like, where's the risk? Okay, here's the risk. The risk is you got more time, but you're not going to hold it for 115 days. And I'm letting you know that right now. We are not going, all right, to hold this for the 115 days. No way, no shape, no how. Okay. You have to select the correct expiration cycle. Again, just 55 days out. All right. you want lots and lots of time premium out there. Okay, step 5. All right, and then after step 5 here, we'll take our first break in this, but step 5, using delta to determine options to sell. Delta is the rate of change of an option for every dollar move in the underlying product. Delta is also more loosely associated with probability of an option being in the money by expiration. Find delta on your selected trading application and open up all strike prices. Okay, so you got to look for delta, delta, delta on every trading application in every way, shape, or form. Okay, we will evaluate the sale of calls and puts separately and according to their respective deltas. So you got to go to your lovely trading application, whatever it may be. All right, in this case, let's come here to Tastyworks. And in Tastyworks, I'm going to type in IWM. Tasty. And I'm going to open up an options expiration of interest. Let's open up the May options. And lo and behold, there's already delta. But if you don't have delta, I always look at delta, so that's why there's delta up there. Just click on delta. Delta, 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 and there's theoretical over here. I just put open interest, okay? So delta, 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 and I start scrolling like a madman through the deltas, okay? So that's how you find delta on Tastyworks. How do you find delta, okay? How do you find delta here in Thinkorswim? Well, you go to your trade tab, type in spiders, open up an option of interest. I don't even care if you're 115 days out, and you change one of these information layouts. Options, theoreticals, and Greeks, go to delta, okay? And once you've got delta in there, open up all strikes. I don't want to see 14 strikes. I don't want to see it. Open them all, okay? Open them all. Open your mind, all right? And again, you're going to evaluate the sale of calls separately from the sale of puts, separately. All right. And I even put a screenshot of 90 days till expiration, the 430 strike calls. Look to sell call option. Okay. Look to sell a call option ranging between 0.07 and 0.11 delta. Okay. Listen, this is a rough and dirty method of calculating the right probability. So these trades are about probability. So when you actually pull this up and you say, look to sell, what was that? What was that between the 7 and what? Okay, make sure everybody gets it. 7 to 11, 7 to 11, 7 to 11. It's going to differ very, very mildly on the puts. So I want to go into the delta, 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 and I want to go to 7, 9, okay? Either one of these would work. That's 115 days out. But I could even open up 87 days. If I go 87 days and he scrolls out of the money and he goes, look, there's an 8 delta, a 9 delta, a 9 delta, a 10 delta, a 10 delta, an 11 delta, 11 delta. I don't know which one I should choose. It's fine. Like, calm down, man. There's medication for you. Okay, seriously. Like, it's okay. Like, just pick somewhere in the middle. You're going to find out how to do this a little bit better when we hit the section on allocation. Again, yes, there's a section on allocation too. Okay, so once you think that you can't take anymore, we're just going to keep pounding this into you and pounding this into you. But selecting the right call option is really important. Okay, again, I say that again, selecting the right call option is really, really important. You know, I just sold this one the other day. It's almost fully profitable, so I'm looking to close it. I sold this one the other day. It's almost fully profitable. I'm looking to close it. I could open up more inventory. That would be okay. The market rallied up a little bit today. I could sell calls, I could sell puts, but hey, listen, right now, just look to sell a call option ranging between a 7 to 11 delta. Now I'm going to show you exactly why. There's actually an equation called probability out of the money, okay? When you sell an option that has a 10 delta, okay, a 10 delta, that would entail, with a 10 delta, about a 91%, okay, probability that this option is going to fall OTM, out of the money. So probability out of the money. So there's about a 91% chance of success on this particular trade. But that 91% probability, and I got to throw this out to you, is in the next 87 days. It's in the next 87 days. You're not going to have this trade on for 87 days, and I'm already foreshadowing. Okay. I'm foreshadowing because I want you to know you're not going to have this on for the next, again, 87 days. You're going to have this on for 30, 40, maybe 50 days at most. That's it. And you're going to pull the ripcord. So the probability of it actually hitting, okay, this is even lower. Doesn't mean you're going to make money over there. Okay. But this trade has a 91% probability of making 1 penny or more by said expiration. That's the definitive answer. Now, to continue on over here, that's selling the call, selling the put. Okay, selling a put, selling put options. So we actually separated selling call options from selling put options. We will talk. Okay, and again, I'm gonna just flip this on for a second. All right, just calm down for a second because we're going to discuss selling calls completely in a separate nature from selling puts because the skew demands that we do so. The skew literally says, okay, calls and puts, not all delta is created equal. Okay. The delta on the puts, we're all the way to a 6 to 10 delta. There's just, it's just a tiny little tweak in there. But the reason that there is a tiny little tweak and what I want you to understand, okay, what I really want you to understand about this is if we look at the call that we're selling, the call we're selling here, let's call it a 430 call. Just bear with me for a second. It's a 430 call. How far out of the money is a 430 call? How far out of the money? The money, okay, the money is where the stock price is. So the money is right there at 385, okay? And this is the 430s. So how far out of the money is it? All right, you're like, it's like 30 plus 15, you're about $45 OTM, okay, on calls. Just hold with me for a second. About $45 out of the money in calls. Okay. Now let's cruise over to the puts. And the puts, and the puts, and the puts, and the puts. So you're about a 610 delta in the puts, 610 delta in the puts, 610 delta in puts. Let's go all the way out to an 8 delta in here. Let's just make it the 300 strike because it's a nice big round number. See that 300 strike? Yes. How far out of the money is that? Okay. How far out of the money is it? Yeah. How about that? It's about $85 out of the money on puts. Want to know what skew is? That's skew. Okay. The skew is huge by huge right now. Skew is huge by huge. So you have to identify the calls separately from the puts. And you're like, should I make them equidistant? No, you should not make them equidistant. Did I say equidistant? I did not say equidistant. I said you got to follow the 6 to 10 delta criteria. All right. And again, for those of you that are super experienced, I mean, I'm serious about this. For those of you that are super experienced, some of you may be able to even sell like 3 delta. But if you go even further out of the money on those puts, if you go to like 3 delta, you better be a hedging fool. Okay. You got to understand hedging. The further you go out of the money, the better hedger you have to be. These trades also have a 90% probability. Okay. 90% probability type trades. This is the big leagues over here. Are we okay? Okay to go. Okay to go. All right. This is a perfect point, okay, to take kind of a quick break. So we're going to come back. We're going to come back in just about 10 minutes or so. I'll throw a little bit of music on. If you are on Eastern Standard Time, I believe it is 11:12. Okay, we'll come back at about 11:20ish. Okay, 11:22. Okay, Eastern Time. So we'll take a quick break and be back here in just about 10 minutes. So hang with us, and hopefully everybody's hanging in there okay during our kind of our first hour here of Ultimate Trades.